A very good morning, friends. So I hope everybody is doing good. And as usual, I hope you've done your cumulative revision on financial instruments so far. I had also told you in the last session as well, I think the remaining, sessions which are there on financial instruments is going to be a little more higher in level. Though, of course, very interesting indeed, but I think the kind of discussions we're going to get is a little going to go up the level. But I think as things becomes more complicated as well, it becomes interesting at the same time. I always believe complications and I would say interesting things happen, along side by side. So we've got 4 agendas of discussions in financial instruments left. One is the concept of derecognition of financial assets and liability. One is the concept of impairment. Then the third concept is hedging. And then we've got discussions on embedded derivatives. My focus today is going to be completely in terms of derecognition. I'm going to first of all talk in terms of derecognition of financial assets. And then I'm going to talk in terms of derecognition of financial liability. The principles, or you can say the criteria, which will decide the derecognition. Derecognition, to remind you, is removal of the asset or liability from the balance sheet of the company. So we need to do a discussions in 2 phases. Number 1, we need to understand the parameters or the criteria on the basis of which a derecognition can take place. And once we decide that a derecognition would take place, we need to understand the accounting as well. So I think let's begin a journey in terms of derecognition of financial assets. So I'm looking in terms of derecognition of financial assets. First, we'll focus on the financial assets, then we'll focus on the financial liabilities later. So to give you, derecognition is basically removal of the financial asset. It's removal of financial asset from the balance sheet of the company. So we need to understand the parameters which will be applicable to decide the removal. So as I said, I'm going to do my discussions in 2 parts. So just keep the 2 focus very clear that for a derecognition perspective, you need to be clear in terms of 2 things. What are the parameters, or you can say the criterias, which will decide the derecognition, and we're going to discuss the accounting as well. Now, as far as the no. So it's based on a chart which is also given in the appendix of Index 109. And in this particular case, okay, so in this particular case, I am going to look at the parameters which is given in the chart in the appendix of Index 109, which tells you that what parameters need to be applied in this particular case. So what I'm going to do, I am going to show you a chart. Don't get scared looking at the chart, because we're going to spend a good time understanding the chart, which is in the study material as well. And it is also given in the appendix to Index 109. So let's have a look first of all at that interesting chart indeed. So let me zoom this chart to you. This is given in the appendix to the standard 109, and it is also given in the study material as well. So I'm just going to have a quick look at this particular chart. So we're just going to have a, first of all, you can say just a overall view, then we'll get a little more deeper into this chart. Now, first of all, if you notice, we are given that Index 109 provides a step-by-step flow chart for making this determination. This determination means to decide whether a financial asset can be removed from the balance sheet of the company. So I'm going to go a little slow so that you're able to catch up the concept very well. I'll give you examples, I'll give you the concept as well, but it'll take some time. So don't get, disheartened in between. So this is getting technical indeed. Don't get worried on that. As we progress, we'll keep accumulating the things as well with a lot of examples as well. But let's first understand the flow. We'll understand the logics also, but first we need to understand the principles which are given in the standard. Now, first of all, I am not looking at the box number 1 because we'll come to the box number 1 later. In fact, I'm not looking at the first box, consolidate all subsidiaries. This is something which you're going to see later when you come to consolidation. Now, this is one question which we will discuss later. This is one question which we will discuss later, but let me just read the question to you. I'm not going to take this as a part of the 3-step model, but I'm just going to put that in your mind at this stage. Determine whether derecognition principles are applied to a part or all of an asset. Interesting. Now, a very simple question would come to your mind. So what do you mean by a derecognition of part of a financial asset? So let me put something in the back of your minds at this stage itself. Though we'll discuss this a little more detail at a later stage, not at this stage. Imagine a financial asset, like for example, a loan given to another entity. So let's say in my balance sheet, I've got a loan and that loan is given to some other company. So for me, it's a financial asset. Now, what you need to understand is the loan has got two cash flow streams. Please hear me very carefully. The loan has got two cash flow streams. One is, you can say, the principal amount. And the other, you can say, is the interest which I am going to get. So a financial asset will have two cash flow streams if I consider, let's say, a loan, for example. So I would say, as far as a loan is concerned, there is a principal amount of the loan, which is the right to receive the principal amount. And there is an interest element as well, the right to receive the interest element. So what the standard technically calls it as a principal strip, and what the standard calls it as an interest strip. So they don't say principal amount or they don't say interest amount. The technical wording used is called a principal strip and the interest strip. Now, is it possible that a company could transfer, let's say, only a principal strip and not the interest strip to another entity? Yes. So when you say a part of the financial asset, in those particular cases, we're looking at a transfer of a component of a financial asset. That means as an entity, I am going to transfer, let's say, for example, only the interest cash flow, the interest strip, or maybe just the principal strip, or maybe a certain percentage of the principal and a certain percentage of the interest strip. So the standard makes it very clear that when you apply the derecognition principles for a financial asset, there are two situations which you're going to see. That is this a derecognition of a part of the asset, or is it a derecognition of the entire asset itself? So right now we're not going to talk about that, but this is one of the questions. So what you need to keep this is in the background. That when you're applying this principle, when you're applying the 3-step model, what you need to consider in your mind is the derecognition is to be done for the entire asset, or the derecognition is to be done for the part of the asset. So when I say part of the asset, immediately what should come to your mind is, are we only considering principal strip or interest strip, or maybe a percentage of the principal and the percentage of the interest strip? Let's go further. So my first step model starts from here. We're going to start with the step number 1 out here. So I'm just going to draw the structure first in your mind on the 3-step model, which I gave you last time as well, but we're going to add some more elements as well. So the very first step which starts out here is have the rights to the cash flows from the asset expired. So this is what I call as a cash flow test. Now, let's not get into what is the concept. Let's only understand right now the flow or the sequence, the kind of questions you need to put across. So the first step is you need to conduct what I say is a cash flow test. As an entity, I need to understand, have the cash flows been transferred? have the cash flows been expired? Now, let me tell you that when you're looking at the step number one, there are three sub-steps in step number one. So when I'm looking at the cash flow test, which is my step number one, there are going to be three sub-steps in that. So this expired is like a sub-step number 1A. So I'm going to put across a question to myself, have the cash flows expired? Now you would say, what do you mean by expired? No worry, we're going to see that later. Don't get worried on that. First, let's get the structure very clear. So in step number one in the cash flow test, there is 1A. You will say, have the cash flows expired? The answer could be a yes or the answer could be a no. Now, if the answer turns out to be a yes, I am decided to de-recognize the asset. Now, the only question remains is, what do you mean by the cash flows have expired? So I think let's also give you an insight at this stage. I would say in simple words, when you're looking at the cash flows have expired, it is basically making an assessment, has a full and final settlement taken place? Let's say, for example, I have a debtor who is supposed to owe me, let's say 10 lakh rupee. I sit down with the debtor and I say, okay, you pay me 9.8 lakhs and let's do a full and final settlement with you. So which means in this particular case, once I sit down with the debtor and do a FNF, that is a full and final settlement with the debtor, in that particular case, what has happened? The cash flows have expired. Because in this particular case, you can say, I will not get any further rights to receive. Whatever I was contractually, got the right to receive, I've already received it. So there is no other contractual cash flows which will be generated from the asset, because in this particular case, you've sat down with the person, did an FNF, full and final settlement. So any further contractual cash flows cannot arise. Mind the words, any further contractual cash flows cannot arise. Now, let me tell you, in this particular case, many people get a confusion that when you say cash flows are expired, so when I sell the asset, is it a cash flow expiry for me? No. When you sell the asset, you are basically transferring the cash flows to another person. You are not saying that the cash flows have expired. Expiry would mean that neither you can receive any cash flows further, nor anybody else can receive cash flows further. Expiry means the end, basically. So for example, when you sell the asset, I will not say it's an expiry. It is basically a transfer of the cash flow. For example, if you go to the bank and get a bill discounted, in that particular case also the cash flows have not expired, because you're passing on the right to receive the cash flows to another entity, the bankers. Similarly, if you approach, let's say, a factoring agency in terms of assigning your trade receivable, in that particular case also the cash flows are not expiring, because you are transferring the right to receive the cash flows to another entity, the factoring agency. So the concept of expiry you need to consider is the end. Neither you can receive any further cash flows, nor anybody else can receive any further cash flows. Then we can say the cash flows have expired. So if you say under the cash flow test that the cash flows have expired, you say yes, they've expired, no further questions asked. The de-recognition of the asset can take place. That means you can easily pass the entry. You can easily pass the entry, bank gets a debit and the financial asset gets a credit, and any balancing figure in this entry is going to be a gain or loss. I've told you the accounting also simultaneously. So in this particular case, I've given you the accounting also simultaneously, that you are going to put the entry bank debit, FA credit, and the profit or loss on the de-recognition goes to P&L. Though it will not be logical to say that the profit or loss, the gain or loss is going to go to the P&L, because if the financial asset is in equity investments at FPT OCI, it would enter in the other comprehensive income. So it's not fair to say that any gain or loss goes in the P&L. It would be better to say that it is going to be P&L or other comprehensive income, as the case may be. Because if it is a debt investments, it goes in the P&L. If it is equity investments, FPTPL, it goes in the P&L. But if it is equity investments, OCI, then you know it enters the OCI. That is one. So in terms of the step number one, your focus is the cash flows expired? If you say yes, it's time to de-recognize the asset, put the entry bank debit, FA credit, and the gain loss in the P&L or OCI as the case may be. Now, but if you say a no, you need to go to the step number 1B, not 2, 1B. So if you say no in this particular case, you need to go to what I call the step number 1B. You need to go to the step number 1B. So I hope, friends, the structure is very clear. No worries. We'll document these steps to you at a later stage. Let's first get the concept clear. Now, when you say no, the cash flows have not expired, you need to put the entry, has the entity transferred the right to receive the cash flows? So then the next step is to put across that if the cash flows are not expired, have you transferred the cash flows? Now, when I say transfer to cash flows, I think I've already given you examples on what is a transfer of a cash flow. Like, for example, if you make a sale of the financial asset, it is a transfer of cash flow. Like, for example, if you get your bill discounted, it is a transfer of the cash flow. Like, for example, if you assign your trade receivables to a factoring agency, it's a transfer of cash flow. Because whatever cash flows you were supposed to receive, you've transferred the right to receive those cash flows to another entity. So sale, assigning the trade receivable, getting the bill discounted is all examples of transfer of cash flows. Now, if you say, yes, I have transferred the cash flows in this particular case, what I need to do? I need to go to the step number 2. So if you say, yes, the cash flows have been transferred, you are supposed to go to the step number 2. So when you say a yes, I am going to go to the step number 2 in this case, if you say a yes. But if you say no, the cash flows have not been transferred, I am going to go to the step number 1C, step by step. So in this particular case, when you say no, the cash flows are not transferred, you are going to go to the step number 1C. Beautiful. I've converted this entire flow chart into a 3-step model. You know, what I've done basically in the entire index is converted and translated all the procedures in a step-by-step approach. And that makes life more simple because you are able to think like artificial intelligence, AI. It thinks on a step-by-step approach. So today I'm going to convert you into AI modeling. Okay, so this is step number 1C then. So I think let's get the consolidation very clear. What I am looking at is a background question. Before I start a 3-step model, I'm looking at a background question. Are you applying the derecognition principles to derecognize the entire asset? Or are you applying the derecognition principles to derecognize only a part of the asset? But we're keeping this in the background to be discussed at a later stage. But when you apply a derecognition principles, it could be an entire derecognition or it could be a derecognition of a part of the asset, where I give you the concept of a principal and interest rate. Then comes the step number 1. In terms of the step number 1, you put across a question, have the cash flows expired? That means FNF, a full and final settlement. If you say a yes, derecognize. If you say a no, step number 1B. And then you say the cash flow has been transferred. And if you say yes, they've been transferred, step number 2. But if you say no, they are not transferred, we go to the step number 1C. And when you say no, it's not transferred, this entire particular circle can be called as a PTA. This entire circle can be called as a PTA. That's called a pass-through arrangement. So if the cash flows are not expired, you need to see if they're transferred. If they're not transferred, you go to a PTA. Is it a pass-through arrangement? Now, what is a pass-through arrangement is something which we need to understand in a little more detail later. So let's not get into what is a PTA at this stage, but we need to understand what is a PTA. But it says, has the entity assumed a contractual obligation to pay the cash flows in an arrangement that meets three conditions, and these three conditions is called a pass-through arrangement. So we will see what is a pass-through arrangement, but you need to see that are the three conditions of a PTA met or not. If you say yes, the three conditions of a pass-through arrangement is met, in that particular case, we're going to go to the step number 2. But if you say no, the derecognition cannot take place. If the pass-through arrangement, the three conditions are not met, then you cannot derecognize. You need to continue to recognize the asset in the balance sheet. Aha! Now it's time to remind you one of the categories of financial liabilities. Do you remember that when a financial asset does not meet the derecognition criteria, it leads to a creation of a financial liability? Remember when I was discussing the various categories of financial liability, I said a financial liability could arise when a derecognition principles of the financial asset is not met. This is the case. So in this particular case, when it says continue to recognize the asset, so what do you do with the money which you get? Because in a pass-through arrangement, you are going to get money. If you are going to get money in this particular case, then I would say in this particular case, what is the entry? The entry is going to be bank account debit and financial liability gets a credit. So let's give you the accounting as well. So which means your mind needs to be very clear. If you pass the expiry, the cash flow expiry, derecognize. If not, you go to the next one. Is it transferred? If yes, you go to step 2. If no, you go to step 1C, PTA. If you say the PTA is met, you go to step 2. But if your PTA is not met, then you need to say continue the asset, which means the parameters to derecognize the asset is not met. So you are going to create a financial liability. I like it. So I guess my step number 1 is very clear. The cash flow test comprises of expiry A, transfer B, PTAC. If you pass the expiry, derecognize. If not, go to the next one. Transferred. If yes, go to step 2. If no, PTA. If yes, go to step 2. If no, then continue to show the asset in the balance sheet and you got to recognize a financial liability for the consideration received. Let me, I think, ask interim in between. Am I, friends, clear with the concept so far? Am I absolutely clear with my chain of thoughts on my step number 1, ABC? What is expiry? What is transferred? PTA is pending. We'll discuss that later. Wonderful indeed. Now, I think let's go to the step number 2 further. Now, if you go to the step number 2 in this particular case, the test changes to what is called a risk and reward test. After you've conducted the cash flow test, it's time to conduct what is called a risk and a reward test. Now, let's not get worried on what is a risk and reward test at this stage, but let me tell you, in step number 1, we were looking at sub-steps. In step number 1, when you're looking at a cash flow test, I was looking at sub-steps. Expiry, then transfer, then pass-through arrangement. But in terms of the step number 2, there are no sub-steps, but there are possibilities. In step number 2, there are possibilities. Either you have transferred the risk and reward substantially, possibility 1, or you have not transferred the risk and reward substantially, that is possibility 2. Or it is somewhere in between, neither substantially transferred nor substantially retained. Hear me again. When you look at a risk and reward test, now how is this risk and reward test evaluated? That is something we'll see later. We will work upon the risk and reward test as well. But keep in mind that we need to make an assessment that when the cash flows were transferred or when it was a pass-through arrangement, is the risk and reward test met or not? So there are 3 possibilities which can arise on a risk and reward situation. Either it is substantially transferred, possibility 1, or it is substantially retained, possibility 2, or it is neither substantially transferred nor substantially retained. Now look at the course of actions in all these permutation combinations. So in this particular case, we go to the step number 2. Is the entity transferred substantially all the risk and reward? The answer is, has it transferred substantially? The answer could be a yes. If you say that risk and reward is substantially transferred, it's time to de-recognize the asset. In this particular case, we'll de-recognize the asset, which means you're ready to pass the same entry in this particular case. Just like the entry you put in terms of the cash flow expiry, the same entry can be done. Sir, we need examples to understand the flow as well. Too early, friends. Don't get worried. You cannot, cram things. You need to first get the concept in terms of movement. Then you get the examples. We'll take good examples where we'll run through this 3-step model with various examples, but it's too early to connect you to various things. We'll see the examples on risk and reward. Don't get worried on that. It is going to be a stage-by-stage learning where you're going to get things. I've already given my disclaimers that, the level is going to suddenly go up now. You're going to see that the level of thoughts in financial instruments is suddenly going up. Okay. So in this particular case, when you see the risk and reward is substantially transferred, if you say yes, you de-recognize the asset, put the entry, bank debit, FA credit, and the gain or loss is taken in the P&L or the OCI as the case may be. But if you say a no, then we're looking at other possibility. Is the entity retained substantially? Is the entity retained substantially? If you have substantially transferred, possibility 1. Have you retained substantially, possibility 2? So when you say yes, it is substantially retained, you continue to recognize the asset, and in this particular case, you are going to put this entry. Same accounting treatment will happen. You cannot de-recognize the asset, and in this particular case, you are going to recognize a financial liability. This is again the same example where the financial asset does not meet the parameters of de-recognition and it leads to the financial liability. But if you say no in this particular case, that is not substantially retained, that is possibility number 3. So if it is substantially transferred, de-recognize. If it is substantially retained, continue. And if it is neither substantially transferred nor substantially retained, then in that particular case, you need to go to the step number 3 now. You need to go to the step number 3 now. And in terms of the step number 3, you're going to conduct another test, which is called a control test. So in terms of the step number 3, we're going to conduct what is called a control test. Now let's not get worried on what is a control test. Let's not worry on what is a control test, but in this particular case, when you conduct the control test, you need to see, is the control retained? If you say yes, it is retained, you continue to recognize the asset, which means the same accounting treatment is done. So when you say the control is retained with me, I have not transferred the control to the other party, then the asset will continue to be recognized in the books of accounts. But if you say no, the control is not retained, but it is transferred. When it is not retained, that means the control is transferred. Then you can de-recognize the asset. But in this particular case, the de-recognition entry is not going to be the same as done above. In this particular case, the de-recognition entry is not going to be the same as above. In this particular case, you are going to do an accounting which is called continuing involvement approach, what you call CIA, CR. Sir, in the morning itself, you have started doing bombardment on us. No, I've just given you a thought approach to think on. Let's consolidate the inputs in terms of this chart. But this is a beautiful chart. which is there for the derecognition principles. It's a wonderful chart which gives you the entire thought process. So let me just quickly consolidate the learnings in terms of the three-step model which is going to apply in this particular case. Because many times people do questions on the concept of derecognition without even understanding whether the principles of derecognitions is applied or not. Because you need to be clear on things. And let me also tell you one wonderful thing at this stage. The derecognitions will lead to effectively three kinds of accounting. The derecognitions will lead to basically three kinds of accounting. One is a kind of accounting which is called full derecognition. When you say derecognize the asset out here, derecognize and derecognize, it is basically called a full derecognition. The second kind of accounting is called no derecognition. And when you say no derecognition, it is when you use the word continue the asset. When you say continue the asset, that is a case when there is no derecognition. And then there is a third kind of accounting which is called a partial derecognition. So derecognition principles applied could trigger three kinds of accounting. Full derecognition, that is this entry. Then there is no derecognition, that is this entry. And then there is a partial derecognition, which is called a continuing involvement approach. And this also would mean that it would create a liability as well. So if you remember now the category of financial liability, it said when the derecognition of financial asset does not happen. In this particular case, you need to recognize a financial liability. And it was also saying when a continuing involvement approach applies. So when you see that the continuing involvement approach applies, then also in this particular case, derecognition will take place, but it's not going to be a full derecognition. It's going to be a partial derecognition, and that is called a continuing involvement approach. Now let's make the structure clear again in your minds. Let's do one thing before we come back on this chart. Let's, I think, get the process very clear. We'll document the detailed steps very shortly, but I think let's get the thought process very clear. So I'm just going to make a run through on the step-by-step approach which should go at the back of the mind. So I'm looking at the principles of derecognition. I'm looking at the principles of derecognition of a financial asset in this particular case. So when you're looking at the principles of derecognition, first get the thought process very clear. How are you going to proceed? So you are going to look at a step number 1A, then step number 1B, and then step number 1C. Then you're going to go to the step number 2, and then you're going to go to the step number 3. Let's get the basic structure. We'll make the detailed notes also, because we need to take a lot of examples now to get the chain clear. I would say when you're looking at the step number 1, A, B, C, the focus is on a cash flow test. When you're looking at the step number 2, the focus is on the risk and reward test. When you're looking at the step number 3, the focus is on the control test. So one thing which you need to be very clear at the back of the mind is there is a sequence in terms of a cash flow test. Then there is a sequence in terms of risk and reward test and a control test. So first you apply the cash flow test, then you apply the risk and reward test, then you apply the control test. I have not given you much about risk and reward or the control test. What is to be evaluated in a risk and reward and a control test, we'll see. But when you're looking in terms of the cash flow test, in step number 1A, we're looking, is the cash flows expired? Then we're looking at, is the cash flows trustworthy? Then we're looking in terms of, is it a case of a pass-through arrangement? This is sub-steps. This is sub-steps. You need to say the cash flows expired, F&F. So when you look at expiry, we're looking at full and final settlement. You're looking at transfer. This is like a sale. This is like assigning the trade receivable, getting a bill discounted, etc. So expiry would mean full and final settlement. Trust would mean passing it on by way of sale. When you sell the asset, the cash flows which you were supposed to get, now somebody else will get. When you assign the trade receivable to a factoring agency, the cash flows which you were going to get is now going to be received by the factoring agency. And then it is a PTA, pass-through arrangement, which has got three conditions which we are yet to see. Now, in this particular case, when you say are they expired, the answer is a yes or a no. If the answer is a yes, it is time to de-recognize the asset. And that's called a full de-recognition. When you say a yes, it is supposed to be a case of a full de-recognition. When you say a no, you need to go to step number 1B, step by step. So the first focus will be, are they expired? If you say yes, out. If you say no, I'll say, okay, go to step 1B. If you say they are transferred, yes or a no. If it is yes, you need to go to the step number 2. Now you need to assess the risk and reward test. In this case, the risk and reward is not required to be evaluated. The first test itself will decide the fate. But if you say the risk, and in this case, the cash flows are transferred, you need to go to the risk and reward test, step number 2. And if you say no, you go to step number 1C. And then there is some evaluation required on a pass-through arrangement. And if you meet the parameters and you say, yes, it is a pass-through arrangement, you again go to step 2. So if the step 1 is met, out. If the step 1B is met, second step. If the step 1C is met, second step. And if you say a no in this particular case, then you need to continue the asset in the books of accounts. And when you say you're going to continue the asset, you're going to recognize a financial liability. So let me pinpoint one thing at this particular stage. This is called a full de-recognition. And this is called no de-recognition. So this is one kind of accounting, which is a full de-recognition. This is a second kind of accounting where there is no de-recognition. A failure of the step number 1C would lead to a recognition of a liability and no de-recognition of an asset. Then you come to the step number 2 in terms of the risk and reward, and you see the risk and reward is got possibilities. The step number 1, A, B, C, sub-steps, but the step number 2 is possibilities. You need to see that is the risk and reward substantially transferred? Is it substantially retained, or is it neither of the two? So you need to see that what is the permutation combinations happening. Is it substantially transferred? Is it substantially retained? Now, how will you make the assessment that it is transferred or it is not transferred or it is retained? We'll see that. Don't worry. So, but once you make a risk and reward assessment, they're substantially transferred, substantially retained, or neither. If it is substantially transferred, then in this particular case, you can de-recognize, and this de-recognition in this particular case is going to be full again, which is the same one. And if you say that it is substantially retained, then you're going to continue the asset in the books of accounts, and continue the books of accounts means no de-recognition, same one. So you pass the risk and reward, de-recognize full. You fail the risk and reward, it is substantially retained, then it is continued. But if you say, we cannot say that it is substantially transferred or substantially retained, then you're in between. Because you need to prove that it is transferred substantially. It is retained substantially. Then if you can't prove the word substantial, you go to neither. And in this particular case, you go to step number 3. Wow. So basically, you can say in step number 2, if you're in a mixed situation where you cannot say that it is transferred substantially or it is retained substantially, then you go to the step number 3, where the focus is on the control test. And when you look at the control test, then there are 2 possibilities. Remember, step number 1, ABC, sub-steps. Step number 2, possibilities 3. Step number 3, possibilities 2. Either the control is transferred or not. So you can say either it is transferred or it is retained. No question of substantial. Just see that it is transferred or it is retained. If you say that it is transferred, then in that particular case, we will go for a derecognition, but this is going to be a partial derecognition. If you say, yes, the control is transferred, I am going to go for a derecognition, but partial derecognition. So this partial derecognition is not the same. It is not the same in this case. A partial derecognition is like a third case. This is called a continuing involvement approach. So you can get an accounting where there is a full derecognition. You can get an accounting where there is a no derecognition, or you can get an accounting which is a partial derecognition. That is called a continuing involvement approach. And even this will also lead to recognition of a financial liability as well. This will also lead to recognition of financial liability. So there are two cases when a financial liability will get recognized. So you can say when the risk and reward test in this case fails, it would lead to a recognition of FL. Or when you can say the control test fails, it leads to a recognition of liability. But the level of liability recognized will vary. So this is a full liability. This is going to be a partial liability. It is called an associated liability, which we'll see later. And in this particular case, when you say that the risk and rewards in this particular case is the control test is retained, you need to continue to show the asset in the books of accounts. And continue means there is no derecognition, which is again the same, the case number 2. So these are the various permutations, combinations, which can trigger out of the principles. Now, I think the million-dollar questions are, what is the risk and reward test? How it is conducted? What is the control test? How is it conducted? And what are the 3 conditions of a pass-through arrangement? So we've understood the flow, but we have not understood what is this 3 conditions PTA. We know expiry now, we know transferred, but what is PTA? What is this substantial transfer assessment, control transfer retain? That's what we're going to work upon. But let me first ask you, friends, am I 100% clear on my chain of thoughts? Is my chain of thoughts absolutely 100% clear to you? Did you get the entire flow of how you are going to think on the principles of derecognition, correct? Okay, let me see. Yes, that's wonderful indeed. Let me also see if there is any questions coming in so far. Nothing on the other part. Okay, that's great. So I think what I need to now make you understand is, number 1, what is this PTA? So we think this PTA is something which we will take on a standalone basis. But let's first understand the concept of risk and reward test. I think let's first concentrate on the risk and reward so that we can get the picture very clear. So let's, I think, do one thing. Let's consider the element of risk and reward. So I'm concentrating on the step number 2, that is on the risk and reward test. Because cash flow test, we've understood the expiry part, the transferred part. PTA is pending, we'll discuss that. But let's first understand the risk and reward so that at least we can, go on a certain flow. At least I can create some combinations on the 2 steps, then we can come to the 3rd one. Now, let's understand one thing. We are going to consider 2 broad examples. I'm going to consider 2 broad examples to understand the risk and a reward test. Now, in this particular case, when you look at a bill receivable discounting, I will first go to the cash flow test, and then I will come to the risk and reward test, and then I will decide my inputs in terms of, do we want to get a bill discounted? So when you said you want to get the bill discounted, the cash flows have not expired, but the cash flows have been transferred to the banker. So I would say, what is the status of the cash flow? They are transferred. They are transferred. So I go to the step number 2 and conduct a risk and reward test. Now, what happens in case of a bill of exchange? When you get your bill discounted from the bankers, what do the bankers tell you? They say, sir, if your debtor doesn't pay the money, you need to go make the money good. So the bankers are very clear when they get the bill discounted. They say that if your debtor doesn't pay the money on maturity, we will get this money back from you. And this is what is technically called recourse. This is technically called a recourse. The bankers get the right of recourse, which means they can get the money back from you. So if I go to the bankers and get my bill discounted and tomorrow my debtor doesn't pay the money to the banker is going to catch my collar. The banker will say, sir, there is a recourse. Now, since you got the money discounted and got the money, please pay the money back. Your debtor is not paying the money. So if it is a recourse, let me ask you, do you think the risk and reward would have been transferred substantially, or do you think would have been retained substantially? Did you pass on the risk and reward to the bankers in case of bill discounting? That if anything goes bad, are the bankers responsible? Are they going to face the music? Are they going to get the risk and reward? In this case, will get passed to the bankers substantially or no? And that's why he said the risk and reward doesn't get transferred. So we can say it is substantially retained in this particular case. And if it is substantially retained in this particular case, so what will I do? I will say that you need to continue the asset in the books of accounts. And that's the reason last time I gave you that when you get your bill discounted, you cannot put the entry bank debit BR credit. In this particular case, the money which you received from the bank is supposed to be a loan which you have taken. You should put the entry bank account debit and financial liability gets a credit. So which means in school, the entry which you learned that was bank account debit, bill receivable credit is not correct under Ind AS. Because in this particular case, the risk and rewards has not gone to the bank. So you mean to say that I cannot show it as a contingent liability? Yes, you cannot show it as a contingent liability. It's an actual liability. Because when you're getting the money from the bankers, the money which you're getting from the bankers is a loan from the bank. It's not supposed to be a bill receivable out. Because you're basically given the bill receivable as a security against which you have raised money. And if you raised money against a bill of exchange, which is security, you've basically taken a loan. Why would I allow the company to de-recognize the asset? And if I allow them to de-recognize the asset, remember the implications, they are going to change a debt equity ratio. You need liquidity and you approach a bank and get a bill discounted. You're basically taking a loan from the bank. And if I allow you to de-recognize an asset, I think it's a wonderful accounting I give you. Because you will be able to, lower down your debt equity ratio. But traditionally, you've taken a loan. The bill receivable is only acting as a security against which you are getting money. I hope I'm making sense. Let's take another example now, and let's take another course of action. Let's say I go for assigning, my trade receivables to a factoring agency. I hope you all know the concept of a factoring. What does a factor do? So I hope you've got some framework in your mind as far as a factoring agency is concerned. So what happens that today I have a certain amount of debtors and I want a liquidity. So what I would do, I will go to the factoring agency, approach them that you can finance me against my trade receivable. So when the factoring agency finances you, first of all, in this particular case, when you assign the trade receivable, it is transferred. The cash flows are transferred. And when the cash flows are transferred in this particular case, when you approach the factoring agencies, there are two kinds of arrangements with the factoring agency. One kind of arrangement is called non-recourse. One type of arrangement is called a non-recourse, and the other kind of arrangement is called a recourse. So you must have already studied at your intermediate stage as well, that when you approach a factoring agency, the factoring agency says that this is a recourse arrangement. If your debtor doesn't pay, we catch your collar. Or it could be a non-recourse arrangement where the factoring agency says that if your debtor doesn't pay, no problem, sir, we'll handle it. The bad debts will be ours. So I think you can easily identify that if the recourse arrangement is there, that means the factoring agency can catch your collar just like a bill of exchange. I would say the risk and reward is substantially retained in this particular case. And if you say that it is a non-recourse arrangement, what is the factoring agency telling me? The factoring agency is telling me that if your customer doesn't pay, it's my bad debt. So when I get the debtors assigned and it's a non-recourse arrangement, I pass on the risk and reward. If the money is not collected from the debtor, it's a loss to the factoring agency. So in this case, I would say the risk and reward is substantially transferred. If it is substantially transferred, in this case, it is time to go for a derecognition, and I will put the entry bank account debit and the trade receivable gets a credit. And if there is any balancing figure, that's going to be again a loss, in this case, entering the P&L. And if it is substantially retained, you are going to continue the asset in the books of accounts. And when you say you're going to continue the asset, a similar entry will be done. I hope these examples are able to give you an assessment of risk and reward. So when I make a sale, there are a lot of permutation combinations still waiting for you on the risk and reward test. I've just given you a basic flavor. I'll give you more flavors as well. I've talked of, a case of bill receivable discounting, a case of a factoring agency. We're also going to talk of sales. And there are plethora of combinations given in the standard, and there are plethora of combinations which are given in the study material as well, where they're talking about sales, which is with repurchase agreements, with options in terms of calls and puts, when they're in, out money. The derivative knowledge which we got is going to be used as well. But I hope this example run through is clear that bill receivable generally is never with a non-recourse. Bill receivable discounting is generally always with a recourse. And therefore, the risk and reward will always stand substantially retained, and therefore, derecognition will not take place. But in terms of factoring agencies, there are two kinds of arrangements. It could be a recourse or a non-recourse, and accordingly, a continuation or a derecognition could happen. So we'll see more inputs in terms of risk and reward. But we've understood one thing: risk and reward is nothing, but you need to see that to the third party, to the other party, when you entered into any kind of transactions, along with the cash flows, did you pass on the risk and reward to them? If anything happens with the financial asset, if there is going to be a bad debts, etc., who is going to bear the loss? If he is going to bear the loss, it's transferred substantially. If I'm going to bear the loss, it is retained substantially. So, but can you also give an example where it is neither substantially transferred nor substantially retained, and you go to the step number 3? No worry, we'll take that later as well. I think let's give you another example at this stage itself. Maybe I can just try to add a flavor at this stage for the third case. Let's try this. Now let's take the case of an assigning a trade receivable itself. And in this particular case, I want to give you the inputs on, let's say, the assigning of trade receivable. The cash flows were transferred. But now in this particular case, look at the arrangement. I went to the factoring agency and they said, "Sir, what kind of arrangement do you want?" I said, "I will give you a guarantee to a certain amount. I will give you a guarantee that I will bear a bad debts up to an X percentage." So it is not telling the person that you get the entire risk. It is not telling that I will bear the entire risk. I'll say, okay, let's share the risk. I am going to bear a bad debts up to a certain percentage. So when I am transferring the cash flows, I give a guarantee to the factoring agency that I will bear bad debts to a certain amount. Since I will say that I am giving a guarantee for a certain amount, I cannot say that it is substantially transferred. I cannot say that it is substantially retained. Since you are liable for an X percentage, in this case, we'll say it is neither substantially transferred nor it is substantially retained. Because when you approach a factoring agency and you say, if bad debts happens, it's yours, substantially transferred. If the bad debt happens, he says, it's yours, substantially retained. Or I give him a guarantee. I say, don't worry, I'll bear bad debts up to a certain percentage. It's neither transferred substantially nor retained substantially. Then in this particular case, you need to go to the control test and decide the fate. Now, what is a control test? We're yet to discuss. So, but I think we've got the flair of the risk and reward test at this stage. The idea was to give you the inputs on the risk and reward test. So I hope the risk and reward is clear. Let's go back. So I think expiry is done, trustworthy is done, PT is pending, risk and reward test is done. Now I think let's understand the control test as well. Then I think we'll make some interesting notes to you. Then we'll make some interesting charts to you. Then we'll do a lot of questions with you where we will be able to see the accounting as well. Wow. I'm sure you must be finding the level slightly going up as compared to the previous classes. You're finding that it's perfectly okay, because the level has actually gone up. Because by this stage, many people start getting disheartened also at times. Sir, मैं तो आगे नहीं कर रहा. I will only do financial instrument till this stage. You need to remember, passing the exam is just one milestone. It's not the end of the journey. Your focus has to be more higher. Your visions has to be more in terms of life. Passing exams can never be the focus in life. Knowledge gaining is important, because if you get knowledge, you pass exams easily, but then it helps you to survive later with all that knowledge as well. Knowledge is power. And I tell power is money. So which means knowledge is money. Okay, so let's take it further. And I am going to add now the element of the control test. Let's have a little feel on the concept of the control test. Then we'll talk in terms of the pass-through arrangement, that is a PTA as well. And remember, all these things, what I am telling you today is something which I again learned on my own, because I qualified my chartered accountancy way back in 1999. When the concept of Indian accounting standard was not even there. I learned all these things after becoming a qualified CA, that also a couple of years later. And I think in this profession, the best part is that as a practitioner, you keep learning day and out. You keep learning new things in life, and that should be a good encouragement. We professionals, of course, can't afford to be, stale. It's not the end that you've passed your exams and the end of the journey. Your knowledge quest for knowledge, your learnings will continue for a lifetime. I think we've taken the passion of being in this profession. I love the profession. Okay, now let's look at the control test in this particular case. When you're looking at the control test, I would say the control test is more like, considering the evaluation of decision-making rights. I would say the control test is more in terms of evaluating what I call decision-making rights. For example, if I make a sale of an investment, which is a financial asset to somebody, then in this particular case, I would say the other person is in a complete, I would say, right to do anything he wants with the asset. He wants to sell it further. He wants to pledge the asset further. He's got a free right to do whatever he wants. So I would say in terms of the decision-making rights, you need to basically evaluate, is he free to take any kind of decisions? Is he free to make a further sale or not? If he wants, can he make a further sale or not? Is he being restricted to make further sale? If no, the control in this particular case is trustworthy. And if the control is trustworthy, it's time to derecognize, and it's going to be a full derecognition in this case. Sorry, not full derecognition, I'm afraid. In this particular case, since the control is trustworthy, this is going to be what I called as a partial derecognition, because in this case, I will apply a continuing involvement approach. Remember, the moment you reach a control test, full derecognitions are not allowed. You meet a cash flow test in terms of expiry, you're allowed a full derecognition. You meet the risk and reward test, In that case, a full derecognition is allowed. But the moment you go to the control test, full derecognition is gone. You will be able to do a partial derecognition, apply a continuing involvement approach. Because the risk and reward is not transferred, but at the same time you prove it that the control is transferred. The other person is in a free manner to do whatever he wants. He can make a further sale. He can do the pledging of the security. So in this case, a derecognition, a partial will happen. But let's say if he is not free, he cannot make a further sale. The control is not transferred. Then in this particular case, the control is retained. And if the control is retained, you need to continue to show the asset in the books of accounts. So I've given you a basic flavor in terms of the control test as well. So I think now what is left over is two agendas. One is that part and entire asset derecognition yet to be discussed. And one is the PTA, the pass-through arrangements in this case. So let's now understand the parameters of a PTA. Or maybe we can do one thing. Let's first create some combinations. Let's forget about a PTA for the time being. We can discuss a PTA as a special agenda. We can discuss the derecognition of part or entire asset as a special agenda. I think let's get the framework clear. So let's first make the notes to you. I think first let's document the notes to you, then we'll make some charts, and then we'll look at some questions. We'll come to the PTA, we'll come to the part or entire asset later. So I think now it's time to start documenting the inputs to you. So let me now give you the parameters. We can say the three-step model. We're looking at the three-step model for financial assets derecognition. We're looking at the parameters in terms of the financial asset derecognition. Now let's make some interesting notes at this particular stage. Let's get the funda clear. After this, I'll give you some examples to understand it conceptually very well. So let's look at the step number 1A. In terms of step number 1A, we need to conduct what is called a cash flow test. Rather, I would say, let's call this a step number 1. Let's not call it as 1A. So this is step number 1. So in terms of the step number 1, you've got a cash flow test. Now there is a sub-step A, there is a sub-step B, and there is a sub-step C. So what is the sequence of thought? So you need to put across a questions, have cash flows expired? You need to put across a question, have the cash flows expired? Underline the word expired. Now what is expired? It means full and final settlement. So when I use the word F&F, it is called full and final settlement. So expiry would arise only when there is a full and final settlement. Nothing else will fall into the concept of expiry except F&F. You are doing a full and final settlement with the counterparty, it is expiry. So when you put that question to yourself, have the cash flows expired? The answer is either a yes or the answer is either a no. If the answer is a yes, I'm putting the inputs full derecognition. I'm putting this as a case of a full derecognition. This is one permutation combination. If the answer is a no, you got to go to the step number 1B, simple and straight. And then after this, you go to the step number 1B, and in terms of 1B, you got to put across a questions, have cash flows been transferred? So you're going to put across a question that is the cash flows being transferred in this particular case, underline the word transferred. Now what is transferred in this particular case? As I said, the bill receivable getting discounted, the sale which is made, or the assigning of the trade receivable. These are examples when the cash flows are transferred. So we can say the examples in terms of transfer. When you're looking at the cash flows being transferred, the example could be, you can say a sale of the asset, or it could be a signing of trade receivables, Or it could be a case, as I said, a traditional example of a bill receivable being discounted. So this is a case where the cash flows are transferred to a third party. And here again, when you put across the questions, the cash flows are transferred or not, so you get the answer yes, or you get the answer no in this particular case. When you say the answer is a yes, in this case now it's time to go to the step number 2. You need to evaluate the risk and reward test at this particular stage. And if the answer is supposed to be a no, then you are going to go to the step number 1C. Step by step, you need to go to the step number 1C in this particular case. So the focus is expiry, the focus is transferred, otherwise a PTA. So let's look at the step number 1C. And now you need to see, are the three conditions, I'm yet to give you the conditions of a PTA, are the three conditions of PTA, I'm putting it as PTA, that's called a pass-through arrangement. Are the three conditions of a PTA, that is a pass-through arrangement, met or not? So we need to decide, is the pass-through conditions, that is three conditions of a PTA, is met. I will be covering the concept of PTA very shortly, as I said, as a special agenda. So I'm just putting it out here. This is covered later. We're just going to cover this later. Let's not take this complication at this stage. So when you look at the pass-through arrangement, here again, the possibility is that the conditions are met or the conditions are not met. So when you say the conditions are met, you are going to go to the step number 2, risk and reward test. And if you say no, in this particular case, you need to continue the asset in the books of accounts. A derecognition in this particular case cannot take place. I hope, friends, the step number 1, ABC, the flow is very clear. Let me overemphasize again that in terms of the step number 1, your focus is 3 sub-steps. Is it expired? Is it transferred? Or is it a PTA? Sub-steps applied. Because in step number 2 and 3, it is possibilities. So this is the step number 1. Now let's go to the step number 2 in this particular case. The focus in terms of the step number 2 in this particular case is on the risk and reward test. The focus in this particular case is on the risk and the reward test in this case. So when you're looking at the risk and reward test, I've already given you a flavor that you need to basically see that when you enter into an arrangement, which is a transfer of the cash flows or a PTA, which we'll see later, have you transferred the risk and reward to the other party or not? So in this case, I said there are 3 possibilities. It's not sub-step, but there are 3 possibilities which will happen in this particular case. And the 3 possibilities which will arise, number 1, the risk and reward is substantially transferred. 1. Possibility number 2, the risk and reward is substantially retained. That is a possibility number 2, that it is substantially retained. Or the possibility number 3 is it's neither, it's in between the two. Neither it is substantially transferred nor it is substantially retained. So in this particular case, let's see the course of action. If it is substantially transferred, then you can derecognize the asset. The derecognition can take place, and this is also going to be a full derecognition, as I said earlier. It's going to be a full derecognition in this particular case. But when you say that it is substantially retained, the financial asset will continue in the books of accounts. And I said, in this case, a financial liability will be taken. Because you cannot derecognize the asset, so you're going to create a financial liability, putting the entry, as I said, bank debit, financial liability credit. And when you say it's neither, then you need to go to the step number 3 and conduct a control test. And finally, when you look at the step number 3, you need to conduct what is called the control test in this case. And I've already given you the control test is more with reference to the DMR, which I said, the decision-making rights. You need to basically see that when you transfer the cash flows, and in this particular case, the risk and reward is, mid situation, as I give you an example, that you've given some guarantee to the agency. In those particular cases, you are not able to evaluate whether the risk and reward is transferred substantially, retained substantially, but in a mid situation. Then you need to see the decision-making rights and evaluate, is the decision-making rights transferred or not? So there is going to be, again, two possibilities, I would say. So there are going to be two possibilities which will arise in this particular case. And the possibility number one is that it is transferred. We're not using the word substantially transferred or retained in this case. Control test is all about the assessment, transferred or not transferred. So when you say it is transferred or we say it is retained. Now, when you say it is retained, we will continue to show the asset in the books of accounts. But when you say it is transferred, I would say in this case, remember, it's not a full derecognition, but it is a partial derecognition. Mind it. Everywhere I am very clearly saying it's a full derecognition, but in this case, it's going to be a case of a partial derecognition. And when we use the word partial derecognition, it is called a CIA, that is a continuing involvement approach. So let me also make a mention that the moment you say it is supposed to be a partial derecognition, this is a case of what we call continuing. It is called continuing involvement. It is called a continuing involvement approach. The partial derecognition is called a continuing involvement approach. We call it as CIA. That's a continuing involvement approach. I hope, friends, now I am pretty clear with the permutations and combinations. Our examples now. So PTA is what we'll discuss very shortly with you. There is an illustration in the study mat which talks about a PTA. So we'll discuss that example very soon with you. But I think before that PTA, let's now take some examples and get a run through very clear that what is the permutation combinations. Because if you look at in the study material, there are a lot of interesting illustrations which are given in the study mat. Like I'll just give you a framework in terms of things. Just to give you a flavor in terms of things, this is illustration number 4. And I'm just giving you a walkthrough. We'll do these illustrations also. This illustration number 4, as I started of the journey, is based on to decide, is it a derecognition of a entire or is it a derecognition of a part of the asset? Remember the background question? That the financial asset is to be derecognized entirely, or is it a part of the financial asset, the principal and the interest, what we were discussing. That is on the illustration 4. We'll come back to this. Then there is another small little illustration also dealing with the same concept. And this is also on the background question that are we going to derecognize a part of the financial asset or not? So illustration 4 and 5 is based on the background question that do we apply the derecognition principle to the entire asset or to the part of the asset? So that is the two illustrations. Then moving further, as we go further in the study, now there is another illustration number 6. There is another illustration 6. Care has been taken and there has been illustration devoted to every concept. That's what I love, the beauty in this particular standard. Good job which is done in the study material to give you a lot of inputs connected with the dots, where you see everything supported by a great example. So you can see this is what is called a proportionate pass-through arrangement. This is what we said, PTA. So there is an illustration devoted to the concept of a pass-through arrangement that is based on the step number 1C. We'll come back to this. So 4, 5, 6 is going to be covered as a special agenda with you. Now you can see there are a plethora of illustrations which are now given on the derecognition principles. So I guess if I take you further, there are some examples now. I'm just, I think, keeping it visible to you. Now, if you notice in this particular case, these examples which are given on the basis of understanding the control test. So we'll be coming to this because there are examples which are given on the control test assessment based on a step number 3. And then you can see the illustration number 7 is on a repurchase agreement. Now, as I said, I am going to cover the aspect of derecognition based on 3 blocks. One is that I'm going to cover the concept of assigning the trade receivable. Then I'm going to cover the concept of, the bill receivable discounting, which we have done. And the third is looking at sales and repurchase agreement. So there are a couple of examples dealing with the concept of unconditional sales or sales with repurchase agreements or option contracts entered. So illustration 7 is on the repurchase agreement. And then there is illustration 8 and 9 further. And this illustration 8 and 9 is covered on the aspect. This is on the put options and this is on the call options. It is all covering the combinations of sales with put, sales with call, and the repurchase agreement, all telling you to make an assessment of typically the risk and reward. So the illustration number 7, 8, 9, as you can see, devoted to the concept of making a risk and reward assessment in this particular case. And then there is another inputs given in terms of illustration number 10, which is on the concept of amortizing the interest rate swaps as well. Wow. So a lot of illustrations devoted to the concept in terms of risk and reward assessment, which we need a conceptual clarity. So before I touch upon these illustrations, I am going to first give you some more inputs at this stage. We're going to create some permutation combinations chart to get the flow of the concept very clear. Okay, and then comes the other section where the accounting treatment of the transfers has been done. And there are 3 cases of transfers as I've broadly already given you. One is a case of full derecognition, one is a case of no derecognition, and one is a case of a partial derecognition, which is a continuing involvement approach. So I want to give you the flow as well. Transfers that qualify for derecognition. This is like the case number 1, which you can call as a case of a full derecognition. And then you can see further in terms of the illustration 11, there is example given on the case number 1. This is a practical illustration which is given on a full derecognition. Then you can see there is a case number 2 which says transfers that do not qualify for derecognition, which is a case of a no derecognition. And then there is a third case as well. And in terms of the third case, we've got the inputs continuing involvement approach that is called a partial derecognition. So I already said this is CIA, a continuing involvement approach, which is called a partial derecognition. And in this particular case, we are given another beautiful set of illustrations starting from the illustration number 12A. Starting from the illustration number 12A, as you can see, we'll be covering this also. The illustration number 12A, then illustration number 12B, and the illustration number 12C. They're all devoted to the concept of, in this particular case, the partial derecognition or the continuing involvement approach. Wonderful indeed. I hope, friends, now you've got the complete flair in terms of the movement. So we've understood the principles of derecognition. We'll be coming to the accounting as well. So let me now quickly consolidate my mind, because I want to now share some inputs with you on certain permutations and combinations to get the real clarity that in this particular case, what is the risk and reward assessment. Cash flow is not a big problem because the focus in terms of cash flow test is expired and transferred. PT is a special case which we'll tackle. Risk and reward assessment is where we need to do a little more work in terms of the illustrations. So let me now come back on the journey. And I am first going to consider the input in terms of something interesting to watch. Now, before we go further, I am giving you more guidance on the risk and reward test, and then we'll make our charts. Let's first have a look at the risk and reward. Now, in the study material and also in the standard at the appendix of Index 109, we are given a lot of permutation combinations in terms of examples when the entity has transferred substantially all the risk and reward. So they are given some examples that these are the finer examples when the risk and reward is substantially transferred. Now let's look at those examples. It says an unconditional sale of a financial asset. If you make a sale without any ifs and buts, if you make a sale without any ifs and buts, you made a sale of the financial asset, the cash flows are transferred, and so would I assume the risk and reward is transferred because it is unconditional sale, no ifs and buts. Next, it says a sale of the financial asset with an option to repurchase a financial asset at its fair value at the time of repurchase. You tell the other person that I am making a sale to you, but I get the right to buy it back. That is a repurchase. But this repurchase will be done at a fair value. Then also, I would assume the risk and reward is transferred. Then he says a sale of a financial asset with a put option or a call option that is deeply out of money. So the input is a sale with a call, a sale with a put. Now let me just give you some inputs before we go to example. Please hear this very carefully. Let's take a very simple example to illustrate this point number C. Let's say there is a company A and it makes a sale to company B. So A makes a sale to company B, and at the same time, A also enters into a long call option. Mind the words, I did not say just a call. I said that A made a sale to B and he also enters into a long call option. What does a long call position mean? I've given you initially at the time of derivatives itself that when you enter into a call option, it means to buy. And when you say that you've got a long position, then we say that you paid a premium to the other party, which gives you the right to buy. So A made a sale to B, and then he said, I pay you a premium where I get the right to buy this item back. So when A says that I get the right to buy this item back, the possibility is that this option could be in money, the option could be out of money, or the option could be at money. If the option is in money, the chances are he will exercise. If you say it is out of money, the chances are he may not exercise. But if I say, for example, that this option is deeply out of money, if I say it is deeply out of money, that means he will not buy. Because if A is paid a premium to B, where he's getting an option to buy it from B, and the option is deeply out of money. So when you say it is deeply out of money, no chance that A will buy this item. If A will not buy this item, then I think it's a case of risk and reward transferred. So as it says, sale of a financial asset with a call option that is deeply out of money. That is deeply out of money. So you need to prove that if A made a sale with a repurchase, that is, you can say a call option, and the call option is deeply out of money, A will not exercise the call option. Alternatively, let's look at another case as well. A entered into a transaction with B where he made a sale of the asset. And then A also enters into what I will say a short put. I did not say put, I said a short put. The standard is saying call put, but I'm adding the terms long call and I'm adding the word short put. Now, in this particular case, when I say A takes a short put, which means B is got the right to sell and A is under the obligation to buy. So there are two ways in which A could buy the item from B. either A takes a call position long where he gets a right to buy, or A takes a short put position where B is under a right. He gets a right to sell it to A. That's a long put for B. Mind the words. It's a long put for B, and for A, it becomes a short put. In this particular case, when it is short put, A is under an obligation. Now, it is B who will decide whether he will exercise the option or not A. Because for A, it is a short put, so B will decide whether he will exercise the option or not. So in this particular case, the position could be at money, the position could be in money, or the position could be out of money. If you say out of money, B has got chances that he may not exercise. If it is in money, chances B will exercise, and at money means indifference point. But when say B says it is deeply out of money, if B says that it is deeply out of money, which means B will not exercise in this case. So when B says it is deeply out of money, B will not exercise the long put. So the asset will not come back to A. So now you can see the position which is given. It says a sale of the asset together with, I will put it like this, together with a put, which is a short put. Or it is a call option, which is a long call. So if there is a sale which is with a short put, or there is a sale with a long put, long call, which is deeply out of money, risk and reward is met. So these are few examples which are given on the risk and reward. An unconditional sale, risk and reward is met. A sale with a long call, which is deeply out of money, the risk and reward is met. A sale with a short put, which is deeply out of money, the risk and reward is met. A sale with a repurchase agreement, where the repurchase price is at a fair value, at the time of repurchase, the risk and reward is substantially transferred. Then we are also given some more examples as well, where we're given now examples of risk and reward, that in these cases the risk and reward is substantially retained. So we are given examples when the entity is retained substantially, all the risk and reward. It says a sale and a repurchase, where the repurchase price is a fixed price, or it is a sale price plus a lender's return. Let's take an example. Let's consider that A made a sale to B. I'll just take some value to explain the transaction as well. So let's consider A made a sale to B, and let's say he made a sale to B, let's say at 100. Then he says, in this particular case, I will buy the asset at the repurchase price, which is 120. So in this particular case, A made a sale of the asset at 100 to B, he got 100 from B. And now what A tells B that I will repurchase this at 120. So what is happening? When A made a sale to B, he got 100 from B. And then after, let's say, a period of 1 year, he purchases it back at 120. So he's going to give 120 back. It's a loan transaction. You make a sale and get the money from someone, and then you buy the asset back at a price which is more than the sale price. When the repurchase price is more than the sale price, the difference is nothing, but it is supposed to be an interest element. It is not a sale, but it is more like a loan transaction. And that's what it says out here. So it says a sale and a repurchase transaction, where repurchase price is either a fixed price or it is a sale price plus a lender's return. Then are some more examples given, but I think I'll just concentrate on that part. And then you can see another example related to the call and the put as well. I'm not reading all the examples, but then there is another interesting example which I'd like to put across. It says a sale of the financial asset with a deeply in money put or deeply in money call. In the previous one, when you said the risk and reward is substantially transferred, we said a long call deeply out of money. And we said a short put which is deeply out of money. So in this case, what we are saying, a long call which is deeply in money, or a short put which is deeply in money. So in the same examples what we saw earlier, if the option is deeply in money, then in that particular case, the repurchase will happen. And if the repurchase will happen, then you can say the risk and reward is substantially retained in that case. So too much data. Okay, let me, I think, just consolidate the picture to you at this particular stage on the risk and reward, and then we'll pen it down. So what is coming to the back of the mind is some good permutation combinations which are there. I think let's make a interesting chart to you at this stage, understanding the risk and reward in a further more detail to you. Then we can go to the practical examples with you at this stage. I'm focusing now on risk and reward. I'm focusing on risk and reward. So as far as the cash flow is concerned, transferred or expired, PTA we'll talk later. So my focus is on the risk and reward, though we'll talk on the cash flow as well. Let's make an interesting input. Now watch this very carefully. I'll just first give you a chain of thought. Then we'll make some interesting chart, putting down all the permutations, combinations. Let me just only concentrate on a risk and reward at the moment. So the plethora of examples which are given in the standard regarding the risk and the reward test. Regarding the risk and the reward test, the standard has given us examples of when you can conclude that the risk and reward is substantially transferred, or when the risk and reward is substantially retained. Now, what you need to keep in mind in terms of things is a couple of situations. I'm just giving you illustrative examples of combinations which we need to keep in mind. So what I'm giving you the example is on the transferred part. If you say that there is an unconditional sale, if you say that there is an unconditional sale, no ifs and buts, risk and reward is transferred substantially. It is simply a sale, no repurchase, nothing, unconditional sale. The second one is that there is a sale, and along with the sale, there is a repurchase agreement as well. Now, what you need to watch out is that if this repurchase is going to be at a fair value at a later date. So the person enters into a sale and a repurchase, and the repurchase is at a fair value, then in that particular case, rewards is transferred. And the next one is that there is a sale. Along with this, there is a long call, or there is a sale, and along with this, there is a short put. Mind the words carefully. So there is a sale along with a right to buy, or there is a sale with an obligation to sell. In this particular cases, what you need to prove is that it is deeply out of money. It is deeply out of money. And why do you need to prove that it is deeply out of money? So that this call option and the put option is not exercised. So consider the concept very clear. If you make a sale with a long call and you know that you're not going to exercise the long call, sale is done. If there is a sale with a short put, the other person will not buy things from you, is not going to sell it back to you. So in this particular case, the short put is not going to be exercised. So what is important is that the options should not be exercised. So they need to be deeply out of money that they're not exercised. Similarly, in terms of the risk and reward substantially retained, we can say there are two combinations we're looking at. One is similar. There is a sale with a long call. There is a sale with a long call, or we can say there is a sale with a short put. So there is a sale with a long call, or there is a sale with a short put. And to say that it will be exercised, it should be deeply in money. So in this particular case, you need to prove the opposite, that it is deeply in money. If you can prove that it is deeply in money, in this particular case, the risk and reward is substantially, you can say, retained. Because you made a sale, you'll repurchase, you'll excise the call. There is a sale and there is a short put. The other person will exercise because it is deeply in money. And the other one, we said that in this particular case, there is a sale and there is a repurchase. There is a sale and there is a repurchase if the repurchase is at a fixed price, Or we can say the repurchase price is equal to selling price plus a return. He's added a return to this, then also this case will follow. Okay, this is great. I think we need to now make some interesting charts to you. You've got some permutation combinations on the risk and reward test. These are certain, I would say, illustrative examples which are given. These are certain illustrative examples which are given in the standard in the appendix itself, which tells you that which case risk and reward is substantially transferred or it is retained. Now, what is going in the back of the mind is we are just left with the case of a PTA, that is a pass-through arrangement, which we need to understand. So we'll understand that PTA, of course, but let's keep that PTA aside. And let's keep that entire and part of the asset aside. So my focus is now the cash flow test. It is expired or it is transferred. There is one agenda. And PTA, we're keeping it aside. Risk and reward, we've got which combinations it is there. Now comes the control test, which I've already given you, is based on a DMR. If as a party, I made a sale and I fail the risk and reward, I conduct the control test to see, is the control transferred to the other party? Is he free to do anything? So before I go to the chart, I just want to now come to the examples on the control test given in the study material, so that the chain of thoughts on the test is clear. Let's have a look at the example 1 and 2 on the control, because cash flow done, risk and reward concept done, control. Then we'll make charts, we'll make combinations, but first, before that, we'll first give you a break to relax your minds as well, and then I'm going to work on the charts with you. So let's see. When you say that the control test is met, you need to prove that the transferee has got the practical ability to sell the asset. If you want to meet the control test, you should be in a position to prove that the other party, the transferee, has got a practical ability to sell. It says the transferred asset is subject to an option that allows the entity to repurchase and it is traded in the active market. Let's consider this simple. I made a sale of the financial asset to another party and the risk and reward is not substantially transferred, not substantially retained. So we go to the control test. Mind the sequence. I go to the control test and I see, is there an active market? Because I made a sale and a repurchase agreement. I made a sale and a repurchase agreement. Now, that particular security which I sold is freely traded in the market. Even if I repurchase at a later date, the other person can buy it from the market and give it to me because it is actively traded in the market. So in this particular case, if the security is actively traded in the market, the transferee will get the practical ability to sell the asset. Sir, if it is not traded actively in the market, then he's got no practical ability to make a further sale. And that's the next example. In which particular case we can say that there is not traded in the active market, he will not have a practical ability to sell. Sir, now there are a few things, we need a little more connect with. Example, we've understood cash flow, we've understood a bit risk reward and a control test, some practicality to sell. Can you now give us some examples where we make a walkthrough on all these three tests and all the permutation combinations? Yes. What I'm going to do, friends, after the break, I am going to make a run through on three different charts to you. I'm going to talk in terms of chart number 1, assigning trade receivable, making a walkthrough on these three tests. I'm going to go through the concept of sale and repurchase agreements with calls and puts, chart number 2. And then I'm also going to give you a chart number 3, bill receivable discounting. I think we'll start with a simple one. We'll consider bill receivable discounting, chart 1. Then we'll consider the case of sale repurchase, third chart. And the second one is assigning the trade receivable. This will cover up all the illustrations number 7, 8, 9 as well. I didn't say 10. 7, 8, 9 automatically will get covered in my permutations combination. So let's do one thing. Let's first take a break. Let's relax the minds. Then I'm going to make some three beautiful charts to you, which will endorse the three-step model. And then we're going to look at the accounting for derecognition of the assets as well. Let's first give you a break, friends. Let's relax your minds. I will join you in 10 to 12 minutes time. Enjoy your break. relaxed mind now. I think it's time to now consolidate these inputs into a wonderful three charts, which I said I'm going to make. So it'll give you a lot of clarity in terms of thinking how the cash flow test is done, how the risk and reward and the control test is applied. The PTA is pending, we'll discuss that, and the part and the entire asset is pending, we'll discuss that. So those issues will be discussed after the chart. So let me do one thing. Let me, I think, first make a very interesting chart to you. And let's consider three charts at this stage. I'm going to consider the chart number one, very simple. The focus is on a bill receivable discount. So these three charts will support you the understanding of a three-step model. So in this particular case, my chart number one is working on a bill receivable which is being discounted. I'm considering a bill receivable which is being discounted. There's nothing major in terms of a bill receivable discounting, but we're still going to make a walkthrough. So in this particular case, let's add another element as well. Let's keep a bill receivable discounting, and let's also consider a full and final settlement of trade receivable. I think let's keep two features in the chart number one, the most simplest in chart one. So we're going to make a walkthrough in terms of the three-step model. So let's keep the transaction here, and we'll consider the three-step model in terms of step number one, ABC, in terms of step two, in terms of step three, and we will consider the remarks, if any. So let's make a column for particulars, or we can say the transaction. Then I'm looking in terms of the step number one, A, B, C. Then I'm looking in terms of the step number two. Then I'm looking at the step number three. And then I'm looking at the remarks. What do we do as an accounting treatment? So let's make a walkthrough. So let me also give you the insights quickly on these steps. When you're looking at A, we're looking at the cash flows are expired or not. When you're looking at B, it is a case where they're transferred or not. C, we're yet to see, but I'm just putting it as PTA. So this is the cash flow test. This is the risk and reward test. And this is supposed to be the control test. Okay, now watch this movement very carefully. You'll get the consolidation of all the inputs which I give you. Let's begin with the first example where there is a full and final settlement. F&F means full and final settlement of a trade receivable. I sat down with my debtor and I said, you owe me 10 lakh rupees. Okay, give me, money. I'll give you a 5% discount. I said, you give me 9.5 lakhs and let's do a full and final settlement. Is the cash flows expired? Yes. Since I sat down with him and did a full and final settlement, no further contractual cash flows can arise to me. A full and final settlement means that cash flows have expired, and if there's expired, no further questions to be asked. It is a case of a full derecognition. It is a case of a full derecognition. Does this mean that I will be able to pass an entry bank debit and trade receivable credit and the balancing figure in P&L? Yes, you can. So let me also put that entry for a better understanding. So in this particular case, I will be able to put the entry bank gets a debit, trade receivable gets a credit, and any balancing figure is again a loss on the derecognition that enters in the P&L. As simple and as straight. Let's see further the second permutations combination. Now let's say we've gone for a bill receivable discounting. Let's say we've gone for a bill receivable is discounted in this case. Now I put across a question that when I got the bill receivable discounting, is the cash flows expired? No. I basically transferred the cash flows to the banker. I said, now you can collect the money from the bill. So is the cash flows expired? No. If they're not expired, you go to the step 1B. Is the cash flow transferred to the bank? Yes. So once you say it is trustworthy, you need to go to the risk and reward. Now we know one thing very carefully, that in terms of a bill receivable, it's never a non-recourse. You cannot imagine a case of a bill receivable where you tell the banker that if my debtor does not pay, your loss. So bill receivable, we know, is always a recourse. It is, we will say, is always a recourse. And if it is a recourse, which means, have you been able to transfer the risk and reward to the bankers? Of course not. So I would say the risk and reward is supposed to be substantially retained with us. It is substantially retained with us. We have not transferred the risk and reward. And if it is substantially retained, in this particular case, you need to continue the asset in the books of accounts. And if you're saying that it needs to be continued in the books of accounts, so let's see the accounting entry also at this particular stage. The entry for the bill discounting is not bank debit BR credit. No, bank debit FL credit. So the entry in this particular case is going to be bank gets a debit and correspondingly a financial liability is recognized for the amount received. We can say for the net amount received. Like for example, the bank would deduct a discount at this particular stage. So when they will deduct a discount at this particular stage, I get a net amount. I'll put the entry bank debit FL credit, and this financial liability subsequently will be accounted at amortized cost accounting. I think makes works mention as well. So when you are going to consider the accounting of this financial liability, so this will be subsequently accounted at amortized cost approach. That was chart 1, simple and straight indeed, where we just got a very basic flavor, and that is when there is a bill receivable discounting, it's never eligible for derecognition. When it is a case of F and F, it's a complete derecognition. I hope, friends, the chart number 1 is perfectly clear. Let's now go to the chart number 2 and let's consider the chart number 2, assigning the trade receivable. So let's have a look at the chart number 2, apply these steps, and this is on the case of assigning. This is on the case of assigning of the trade receivable. Indirectly, we are saying that you're basically entering into a factoring arrangement. Assigning a trade receivable means that you're entering into a factoring arrangement. So I want to look at the permutation combinations that when you enter into a factoring arrangement, then what kind of combinations could arise. Let's again make the chart on the same lines. So I am going to make the same inputs. Let's take the transaction. We're going to take the step number 1, step number 2, step number 3, and the remarks. So we're looking at the step number 1, ABC. That is the cash flow test. We're looking at the step number 2, which is risk and reward test. And we're looking at the step number 3, which is the control test. And then we'll see the remarks in terms of what kind of accounting is to be applied in this particular case. So let's begin with the transaction. So let's take a column particulars and let's see the transaction. Now, in terms of assigning the trade receivable, you all know from your intermediate understanding as well that factoring is of 2 kinds. Either you enter into a factoring arrangement with a recourse, or it is entered with a non-recourse. A recourse means that if you assign your debtors to the factoring agency, they can, tell you to pay the bad debts. And if it is a non-recourse, then they don't ask you to pay the bad debts. So in this particular case, when I am looking at assigning of trade receivable, when I'm looking in terms of assigning the trade receivable, I am looking into 2 kinds of situations. One is it is with a recourse, and the other one is that it is with a non-recourse. So let's make a walkthrough in terms of what is going to happen in this case. Let's go with the recourse first. So is the cash flows In this particular case, can we say that they are expired? No. Because when you assign your trade receivable, it's not a full and final settlement. You are telling the factoring agency from now onwards, you will get the cash flow. So the cash flows are transferred, yes. Then I go to the risk and reward test. If it is a recourse, I would say the risk and reward is substantially retained in this particular case. Because if it is a recourse, that means if there is anything happens, the factoring agency is not responsible. So this is a case where the risk and reward is still retained with you. And if it is retained, then in that particular case, there is no derecognition which can happen in this particular case. You need to continue the asset in the books of accounts. So what is the journal entry which you could pass in terms of this? Same entry, you will put the entry bank account debit, financial liability credit. This is with the net amount received again. The asset will continue in the books of accounts and a financial liability will be created for the amount which is received on assigning the trade receivable. Now let's see the combination where there is a non-recourse in this particular case. If it is a non-recourse, the cash flows are not expired, but yes, they are transferred. And then you go to the risk and reward and put across a question. In this particular case, when you gave your trade receivable to the factoring agency, if my debtors don't pay, it is his loss. It is his risk and reward that he bears the bad debts. So we can say the risk and reward is substantially transferred. And if it is substantially transferred, then in this particular case, a derecognition can happen. You can derecognize your trade receivable out of the books of accounts in this case. So what is the entry which you are going to pass in this case? Bank gets a debit and the financial asset gets a credit, and any balancing figure gain or loss will be taken in the profit and loss account. Great. So this is a case of a trade receivable. I've done two cases with you. Settlement of a debtor, bill receivable discounting, chart 1, and then assigning trade receivable, entering into factoring agency, recourse and a non-recourse arrangement 2. Now comes the complicated chart, which is chart number 3, and which is going to be a case of sale with a repurchase or with put options, whatever. So let's see a chart number 3 now at this stage. And this will consolidate the entire concept to you very interestingly. I know I've already disclaimed that at the very start itself. And I said, the level of financial instruments has now gone up. Are you feeling the same? Say yes or no. I guess you must have seen that the level is, suddenly pushed up. And is this going to go up further, sir? Yes. You're going to see in terms of impairments and in terms of hedging. But I'm going to give you very good knowledge in terms of impairment and hedging as well, giving you a lot of good understanding, because that is also one gray area where people tend not to understand. But I will explain that, of course, to you. That's brilliant indeed. Okay, now let's go further and let's see the chart where we're looking at a case of a sale and a repurchase, a case of a repurchase agreement. So it is a sale and a repurchase agreement, or it is an option contract which is entered. So let's see the permutation combinations in this case. Now we've got some good number of combinations coming in. Watch this carefully, because this chart will decide now the entire chain in terms of things. Rather, let's do one thing in chart number 2. Let's also add another inputs as well. No, I think no, let's not put that at this stage. So in this particular case, I am considering the transaction. This is my step number 1. This is my step number 2. And that is my step number 3 and the remarks. So let's take the particulars and then we consider step number 1 ABC. So this is my cash flow test. Then this is my risk and reward test. That is step number 2. Then there is a control test, which is step number 3. and we're going to give the remarks, decide on the nature of accounting. Now watch this carefully. This is a crucial chart to get your concepts very clear in this particular stage. Now I'm looking at the combinations of things. Number one, I'm looking at an unconditional sale. I'm looking at an unconditional sale. No ifs and buts, just an unconditional sale. Have the cash flows expired? No, they've been transferred. The cash flows is not expired. Yes, they've been transferred. I go to the risk and reward test. Is it substantially transferred? Yes. If you made a sale, you got the consideration. So I assume that the risk and reward is being substantially transferred. And if it is substantially transferred, you can go for a full derecognition at this stage. The full derecognition, you already know what is to be done. Bank debit, financial asset gets a credit. That's it. And whatever gain or loss is there is taken in the P&L. It's an unconditional sale. Next. We're looking at the next permutation combination, that there is a sale and a repurchase agreement. Not a call and put, but we're just looking at a sale and a repurchase agreement where I'm looking at two combinations. I'm looking at two combinations. This sale and repurchase, the repurchase price is fair value. So in this particular case, we say the repurchase price is equal to the fair value, or the repurchase price is equal to the selling price plus the lender's return. Or it is supposed to be selling price plus a lender's return, which I said earlier, that it is either equal to the fair value or it is a selling price plus a lender's return, more like a loan arrangement. So in this particular case, let's see, is the cash flows expired? No. Are they transferred? Yes. You go to the risk and reward, and the standard is very clearly said, the risk and reward is substantially transferred in this case. If I make a sale to someone and I say I'll purchase at a fair value, I can repurchase from anybody else. Why he? Because if the item is to be repurchased at a fair value, then why would I be interested in repurchase? If it is available at a fair value, I can buy it from anybody else. Why would I repurchase? So the possibility of a repurchase is zero. So in this case, the risk and reward is substantially transferred. And if it is substantially transferred, it is again a case of full derecognition in this particular case as well. Let's now see if it is supposed to be a case of, you can say, repurchase price is selling price plus a lender's return. I made a sale, I got 100. I'll repurchase and give back 120. Loan. It's a loan. I sell, I get 100 from you. I repurchase, I pay you 120. So it is a loan. So is the cash flows expired? No. Are they transferred? Yes. And the standard very clearly says it is a case where the risk and reward is substantially retained. And if it is substantially retained, in this case, there is no derecognition. The financial asset will continue, and you know that a financial liability will be recorded in its place. You can record a financial liability in its place in this particular case. Let's now see more combinations coming in. And the third permutation combination is that there is a sale along with a long call, or it is with a short put, which I said earlier. So it is a case of a sale with a long call, or it is a sale with a short put. I made a sale along with the right to buy, or I made a sale with the obligation to buy because the other party has got the right to sell and I'm under obligation. So I would say there are two situations. Either it is deeply out of money. It's not out, but it is deeply out of money, or we can say it is deeply in money. So we're not looking at the case of in at out at the moment. We'll see that in out as well, but little later. So we can say that there could be two situations. When you made a sale and there is a call option, right to buy, it's deeply out. I'm not interested to buy. If I'm not interested to buy in this particular case, I would say cash flows expired, no. Transferred, yes. If it is deeply out of money, I will not buy it. The risk is substantially transferred in this case. And if it is substantially transferred, there is going to be a full derecognition in this particular case. A full derecognition will take place in this particular combination. And if it is deeply in money, expired, no. Transferred, yes. And it is substantially retained in this case. Because if it is deeply in money, you will buy. If you will buy, the sale is not taken place. The risk reward is not transferred. So in this particular case, there is no derecognition. You continue to show the asset in the books of accounts. If you notice, my focus is being mainly on the step number 2 in all these charts so far, because I never failed my step number 2. I only passed the step number 2. Now let's add the inputs in terms of another chart. Let's take a little blend and let's go to the chart number 4, where I'm going to give you situations where the risk and reward will fail. Because in these previous charts, if you notice, whether it was chart number 1, the step 2 was either not required or it was supposed to be, failing. We didn't go to step 3. Even in this particular case, in the chart number 2, we never went to the step number 3. Even in terms of the chart number 3, we never went to the step number 3. So as it is, I've always maintained a balance of 3 charts, 3 steps with 4 charts. I think this time also let's make a 4th chart as well. Let's fail the risk and reward that neither case, so that we get into the control test, a blend of situations picked from here. Let's go to the chart number 4, the final chart to you. So let's see the chart number 4, and the focus in terms of the chart number 4 is where the risk and reward falls in the category of neither transferred nor retained substantially. So I want to now enter the control test for things. So let's create some combinations picked up from the chart 2 and 3. We're going to pick up combinations from chart 2 and 3. You need to sit down, friends, today and make your consolidated revision of this concept. Because what I am doing today, I know is quite technical indeed. But once you're going to look at this, if the need be, look at the video again. Get your fundas very clear. Try the illustrations. You will get a good level of clarity regarding the principles for derecognitions. So let's consider this particulars. Then I'm looking at step 1 ABC. Then I'm looking at step number 2 and step number 3. And we're going to look at the remarks of what is the prescribed treatment to be done. This is the cash flow test. This is the risk and the reward test. And this is the control test. Let's now make a walkthrough on the chart number 4. So let me now give you some inputs. Watch this carefully. So I am looking at now the case number 1. It is assigning trade receivables. It is assigning trade receivables. And I'm going to look at the case number 2, which is a sale along with a long call. So this one is picked up from chart number 2. This is picked up from chart number 3. Or there is a short put. And then I'll see the permutation combination. Now watch this carefully, where the step number 2 fails, and you need to go to the control test in this case, and that decides the fate of accounting. Because after that, we can go to these accounting illustrations as well. I know the PTA is pending. I know the part or the entire asset is also pending for the time being. Okay, so this is the cash flow expired? No. Is it transferred? Yes. And if it is transferred, I go to the step number 2 on the risk and reward. Is it a recourse? Yes. But it's a recourse up to a certain limit. Mind the words. I entered into an agreement with a factoring agency. He said, if your customers don't pay, I said, I'll be liable, but only to a certain amount. I guarantee that I will bear a bad debts only to a certain limit, not everything. I tell him very clearly that I will be responsible to bear the bad debts, but up to a certain limit. So it's a recourse. I'm saying it is a recourse, but it is up to a certain limit. So you are saying that I will be responsible only up to a certain limit. I don't have an unlimited liability of bad debts. You're telling the factoring agency that I am going to bear the bad debts only up to a certain level, not beyond that level. Is the risk and reward substantially transferred? No. Substantially retained? No, neither. So when it is a recourse with certain limits, I can say it is neither transferred nor it is substantially retained. You go to the step number 3 in that case. So when it is a case of a trade receivable assigned, when the risk is, when it is a complete recourse, then we can say no derecognition. When it is a complete non-recourse, it is a case of complete derecognition. And if you say that I will be responsible and recourse but to a certain limit, then in that particular case, it's neither transferred nor substantially retained. You go to the control test. Now, the question rises in this case, what is the fact? Do you get the practical ability? Everything depends upon, do you get the practical ability to actually further sell the asset? You need to understand that is there a practical ability to further sell it? That means the practical ability arises if that kind of an asset has got an active market. So the practical ability is all based on whether an active market is present or not. If you say yes, an active market is present. If you say yes, an active market is present, the control test is met, and this will be a case of a partial derecognition. This is going to be a case of partial derecognition. So remember, till you are in step number 1 and 2, it's either full derecognition or full continuation. It is only when you go to the step number 3, it can be a case of a partial derecognition, which we've already called it as a continuing involvement approach. And if you say, no, I don't have the ability because there is no active market, in this particular case, the asset will continue in the books of accounts. So this is how the step number 3 is going to be applied when you say risk and reward neither substantially retained nor substantially transferred. You are in a mixed situation, and it all depends. Active market is present to further sell. If yes, partial derecognition. If no, continuation. Let's look at the other combination now. Now see, sale with a long call and sale with a short put could be a case where it is in money, or you can say it is out of money, or you can say it is at money. So earlier we were looking at deeply in, deeply out confirmed cases. If it is deeply in, substantially retained. If it is deeply out, substantially transferred. So you can guess if it is in at out, then it is neither. You're getting my point? When you look at these options and you say it's deeply out of money, that means you will not exercise. Transferred. Substantially transferred. You say it is deeply in money, I will exercise. Substantially retained. But if it is in at out, in all these cases when it is in out, I will say cash flows expired, no. Transferred, yes. You go to the risk and reward. Since it is in at out, I would say it is neither. You are not sure, because you will exercise or you will not exercise. So it is a case where it is neither transferred. And in this particular case, when it is neither transferred, you go back to the control test. And the fate of the control test decides the accounting. This is the 4th chart, which gives you a permutation combinations in terms of the control test. I think now before we go to the PTA, And before we go to the part or the entire asset, it's time to take you to some illustrations so that we are very, very clear. So I'll not take the PTA at the moment. I'll not go to the part or entire derecognitions. We're going to go to the questions on the accounting part. We'll do illustration number 7, 8, 9, and we're also going to look at the accounting treatment illustrations 12A, B, C. Aha. So that's what we're going to do now. A couple of illustrations on the concept of derecognitions with you. You're going to apply these charts now with me and get a complete understanding. Let's now go to the study material and let's have a look at the illustrations now with you. So we're leaving 4, 5, 6 at the moment because they are on other concepts. I want to first come to the inputs in terms of illustration number 7. Let's have a look at illustration 7, then 8, then 9, then 11, and then 12 ABC. Entire concept of derecognition will get taken care. Let's have a look now, illustration 7. A financial asset is sold under a repurchase agreement. Repurchase agreement means I'm looking at the chart number 3. When I look at the case of a bill receivable discounting, it goes to chart 1. When you look at the concept of assigning trade receivable, chart number 2. When you look at a sale repurchase, chart 3. So what is going at the back of my mind is the application of the chart number 3. Let me read the inputs. Maybe you can decide, is it a case of partial, full, or a case of no derecognition? Let's get your inputs. The repurchase price as per the agreement is a fixed price. It is a fixed price, or it is a sale price plus a lender's return. So when he says that the repurchase price is a fixed price, or the repurchase price is a selling price plus a lender's return, decide full derecognition, no derecognition, or partial derecognition. You know this. Give me an answer. What are you going to do in this particular case? When you sold the asset and you apply the cash flow test, I would say the cash flows are transferred. I go to the risk and reward test in this particular case. It is a sale with a repurchase. Then what do you say? Look at the chart number 3 which I gave you. A sale and repurchase at a fixed price. So I think I'd like to take you back on the chart number 3 which we did, and you can connect out here. Have a look at the chart number 3. It says if the sale price is supposed to be a selling price plus lender return, or we can also add, or it is supposed to be a fixed price, or if it is supposed to be a fixed price, then in this particular case, we can say there is going to be no derecognition. So I think let me just come back. So I've already given that combination out here. Let's have a look further out here. So this was my illustration back out here. Yes. So in this particular case, we can clearly see that since it is a fixed price plus sale price plus a lender's return, no derecognition can take place because the risk and reward in this particular case is substantially retained. Because it is substantially retained, we can say no derecognition will take place. Then he's giving you some permutation combinations which doesn't change the answer, which he says the repurchase is for the same asset. The repurchase is substantially the same asset, or it provides the right to substitute an asset that would not make any difference to the concept. Whether the repurchase is for the same asset, or is it for a similar asset, substantially similar asset, or it is substitution, does not make a difference. In each of these scenarios, the asset is not derecognized because risk and reward is substantially retained in this particular case. Though you can explain this in a 3-step model, what I've done in the chart. Step 1, the cash flows expired, no. Transferred, yes. You go to the risk and reward, and since the selling price, the repurchase price is equal to selling price plus lender's return, it's a loan. Or the repurchase price is a fixed price, it's a loan, therefore no derecognition would take place. Let's go further to the next illustration, illustration number 8 and illustration number 9 on the combinations. It says a financial asset is sold and the trustworthy has got a put option. When the trustworthy has got a put option, I am the transferor. And if he's got a put option, he's got a long put, I've got a short put. So which means it is a case of sale along with a case of a short put. So everything depends upon whether the option is deeply in, deeply out, in at out will decide the status. It says if the option is deeply in money. You know that if it is deeply in money, then the risk and reward is substantially retained. And if it is substantially retained, no derecognitions can take place in this particular case. And when you say that it is a put option deeply out of money, when you say it is deeply out of money, the risk and reward is substantially transferred and a full derecognition can take place in this case. This is based on my chart number 3 again. A sale with a short put. So when you say that it is deeply in money, it is retained substantially, no derecognition. It is out of money, then in the deeply out of money, it is supposed to be transferred, derecognition would take place. Let's see illustration 9. A financial asset is sold and the transferor has got a call option. Here it was transferee. Here it is transferor. So I am the transfer. I have a call option, a long call. So which means it is supposed to be a case of sale plus a long call option. So here again, everything depends upon is it deeply in money or is it deeply out of money that will decide the status. It says the call option is deeply in money. So if it is deeply in money, it will be exercised. So it is substantially retained. And if it is substantially retained, no derecognitions would take place in this case. And if you say that it is deeply out of money, it is substantially transferred. In this particular case, a full derecognition can take place, all again based on the chart number 3 again. And see the interesting part, call option is neither deeply in money nor deeply out of money. Aha. Neither deeply in money nor deeply out of money. That means it is in at out money. If it is in at out money, you need to go to the control test. So in this particular case, what you need to do, you are going to go to the control test and everything will depend upon the control test in this particular case. So in this particular case, everything would depend upon the control test. So let's see what is being said on the third part. In the third scenario, the asset is derecognized, but this is going to be what is called a partial derecognition, and that is called a continuing involvement approach. We are saying that the control is transferred. The risk and reward is neither. You go to the step number 3 and it is transferred. This is because the entity has neither transferred nor retained substantially and has not retained the control. Though I would say in this case, I am indirectly assuming, because there is nothing given on the control test, it is just given that a financial asset is sold. When I say that the control is transferred and not retained, I am indirectly saying that there is an active market. And since there is an active market, which means a further sale by the third party can be done. So assuming an active market is present, we are saying the control is transferred. So a partial derecognition would happen. A continuing involvement approach will be done. So we have seen the illustrations on sale and repurchase. We've seen on sale with call options and sale with put options. 10th illustration you can do because that's a little different. I don't want to get into and the concept goes off. Having now understood the parameters for derecognition, I am now going to go to the 3 kinds of accounting. Full derecognition, 1. Second, we need to see the concept of no derecognition 2. And third, we need to see that there is a partial derecognition, CIA. We need to see the accounting in these 3. So let's go to the first case. So let me just directly go to the example now. This is one example on full derecognition. There is no example on no derecognition, but there is a good example on a partial derecognition as well. So in terms of accounting, I'm going to deal with only two examples. One is a full derecognition and one is a case of a continuing or a partial derecognition. There is no question which is given that there is no derecognition. Let's have a read. I'm now going to read the input. It says S assigns the trade receivable. When I read the word assigns the trade receivable, what should come to my mind is the chart number 2. Because in chart number 2, we are looking at assigning the trade receivables to a factoring agency. Everything depends upon recourse or non-recourse. The carrying amount, that is the book value of the receivables, is given, and the consideration received in exchange is 9 lakh. Customers have been instructed to deposit the amount directly in the bank account for the benefit of AT. AT has got no recourse to ST in case of any shortfalls in the collections. So the arrangement is a non-recourse one. If I apply my 3-step model, I will first of all look at the cash flow test. Is the cash flows expired? No. Is the cash flows transferred? Yes. Assigning is transfer. I go to the risk and reward test in this particular case. Is it recourse or a non-recourse arrangement? It very clearly says there is no recourse. Since there is no recourse, the risk and reward is substantially transferred. And if it is substantially transferred, in this particular case, it is a case of a full derecognition. You can go for a full derecognition in this particular case. A full derecognition will mean what? Can I put the entry bank debit trade receivable credit? Yes. So I will put the entry bank account debit in this particular case. The amount of consideration received is 9 lakh rupee and the financial asset trade receivable gets a credit, which is to the extent of book value, that is 10 lakh rupee, and the balancing figure 1 lakh is the loss which will be taken in the P&L, loss on derecognition as well. And if you want, you can read the solution as well. It clearly says ST transferred the rights, the cash flows are transferred, and they've transferred substantially all the risk and reward. So risk and reward substantially transferred, because the credit risk is the most significant risk in the situation. You're passing on the credit risk. If everything, credit risk means the risk of default, the risk of non-payment. If it is a no recourse arrangement, the risk of the non-payment falls on the factoring agency. Accordingly, he derecognizes the asset, recognizes 1 lakh, the difference between the consideration and the carrying amount as an expense in the statement of P&L. That's what I've done the entry. The financial asset will be derecognized, bank, you get the money, and the gain loss is a profit loss on a derecognition. Example 1, full derecognition. Let's now look at a continuing involvement approach, which I am going to explain with an example. I'm going to explain with an example that what is the concept of CIA, a partial derecognition or a continuing involvement approach, which is going to apply only when you fail, when you enter the control test. Remember one thing very clear. When you're within the step number 1 or 2, you're either considering no derecognition or you're considering full derecognition. It is only when you enter the step number 3, the control test, it is either no derecognition or partial derecognition. Step 3 does not trigger a concept of full derecognition. It only triggers the concept of continuing involvement approach. Let's read illustration 12A. C agrees with the factoring company to enter into a debt factoring arrangement. You are assigning your trade receivable, and by assigning the trade receivable, it is my chart number 2. Chart number 2 or 3, I think 3, yes. Under the terms of the arrangement, the factoring company agrees to pay 91.5 crores less a servicing charge of 1.5 crores. So they're willing to pay 90 crores net on this arrangement. And they want in exchange 100% cash flows from the short-term receivable. The factoring agency says that I will give you a net 90 crores and I would get the right to get 100% cash flows from your trade receivables. The receivables have got a face value 100 crores and a carrying amount of 95 crores, which means he's created a provision for doubtful debts. If this is the gross amount of the debtors and this is the net amount, 5 crores seems to be a provision for doubtful debts. The customers will be instructed to pay the amount into the bank account of the agency factoring. Now see what it says. Entity C also writes a guarantee to the factoring company under which it will reimburse any credit losses up to 5 crores over and above the expected credit loss of 5 crores. That's a crucial sentence. The transferor in this particular case is already recorded a bad debts, a provision for doubtful debts. That is an expected credit loss of 5 crores. The gross amount of the debtors is 100 and the carrying amount is 95. He's already created a provision to the extent of 5 crores. And you will see later when we come to the concept of impairment that this provision is created with the help of what we call an ECL model, expected credit loss model. So in this particular case, the company is already recognizing an expected credit loss of 5 crores on non-payment. Now see what it says. He tells the factoring company, I give you a guarantee under which I will reimburse any credit losses up to 5 crores over and above the expected loss. He says that 5 crores which I've created a provision and another 5 crores I will bear. He's setting a limit. He's setting a limit up to which he will bear this bad debts. So is the risk and reward substantially transferred? No. Substantially retained? No. Is it a case of neither? Yes. Did you get my point? So when you enter into a recourse arrangement, retained substantially. When it is a non-recourse, transferred substantially. And when you say in this particular case that there is a guarantee, you are going to bear an amount up to a certain limit, it's neither transferred nor substantially retained. You need to go to the control test. And in this particular case, I will assume an active market unless mentioned otherwise. If there is nothing given to the contrary on the control test, I'll assume an active market, a partial derecognition would trigger. It says the guarantee is estimated to have a fair value of 0.5 crores. Oh my God. Now there is a financial guarantee as well. And when there is a financial guarantee, the financial guarantee is not a contingent liability, but is measured at a fair value as a financial liability as well. So the guarantee is 0.5 crores fair value. Calculate the amount of continuing involvement asset. So now we need to understand that what is the asset which will continue and what is the liability which will be created in the books of accounts. The standard says the continuing involvement is going to be equal to the lower of the two amounts. Your continuing involvement asset will be equal to the lower of the two amount. So one is the book value of the asset, that is 95 crores. And the guaranteed amount, which is supposed to be 5.5 crores. Why am I calling the guaranteed amount as 5.5 crores in this particular case? Because in this particular case, you've got a guarantee of 5 crores and the fair value of the guarantee is another 0.5 crores. So this 5.5 crores is the amount of the guarantee which you gave and the fair value of the guarantee, that makes it 5.5. So what is the maximum liability which can trigger is to the extent of 5.5. So in this case, you need to consider the book value of the asset, or you need to consider the value of the guarantee, amount of guarantee plus the fair value of guarantee. So this comes to 5.5. So your continuing involvement asset is 5.5. Don't worry, wait for another few minutes. I'm going to give you the context of the entire entry as well. This is illustration number 12A. Then he says, continuing the illustration number 12A, please calculate the associated liability as well. The associated liability will also be created to the extent of the guarantee amount and the fair value of the guarantee. So in this particular case, the associated liability is the sum total of the guaranteed amount plus the fair value of the guarantee, which is again 5.5 crores. We are moving towards the entry now. So now it says that continuing this give me a journal entry in the books of accounts. So this is the entry which we are going to do in terms of continuing involvement approach, that is called a partial derecognition. Now watch this entry carefully, then I'll give you the entries comparatively. So if you look at the illustration number 12C, let's have a look at the entry carefully. The cash is debited with the amount received. That is clear. Then there is a continuing involvement asset that is 5 crores and a continuing liability as well. Contra entry. Mind it, it's a contra entry. You're putting an entry CIA, asset containing involvement asset, AL, associated liability, contra entry. So you can even split that entry separately. Let me do one thing. You can put two entries. I'll show you. So if there is a continuing involvement approach, you can put an entry CIA, continuing involvement asset debit, associated liability credit. This is to the extent of 5.5 crores. Segregate the entry. So you can see the continuing involvement asset and the associate liability is gone. Then you put another entry that is bank account debit. The bank account debit is you get 90 crores and the trade receivable is derecognized at a book value and the balancing figure is going to be taken in the P&L. That's a loss on derecognition. You can see the cash is given a debit at 90, the loss is 5 and the receivables is 95. What is the moral of the story? Isn't this entry similar to a full derecognition? Yes. If you see this carefully, this is an entry which is for a full derecognition. So you're passing another entry and recording the asset and liability. This is called continuing involvement. So what I want to show you at this particular stage, when the standard prescribes 3 different kinds of accounting, you must look at the entry on a comparative basis. Watch this. If you want to have a look at the entries, just watch this carefully, how the entries will look like. So there are 3 kinds of accounting entries which you will confront on the derecognition of a financial asset. You're going to see when it is a case of a full derecognition or when it is a case of no derecognition or if it is a case of a partial derecognition. So there are a total of 3 kinds of accounting which are prescribed regarding the derecognition of financial asset. Either it is full or it is no, or it is supposed to be a partial derecognition. Now, if it is a case of a full derecognition, the entry is bank gets a debit, the financial asset gets a credit, and any balancing figure in this entry is the gain or loss enters in the P&L. That's one. When there is no derecognition, you put the entry bank gets a debit, and in this particular case, the financial liability gets created. The financial asset is not derecognized, but a financial liability gets created. And in this particular case, what do? You blend the entry. You blend the entry bank account debit, financial asset gets a credit, and the balancing figure is taken in the P&L. So you are indirectly, you can say indirectly, you are putting this entry as well. And you're putting another entry, a similar kind of entry out here as well, recognizing a liability, but there is a continuing involvement asset and there is associated liability given a credit. But remember, what is the difference? This entry is with the entire net amount received. This is with the entire net amount which is received. But when you're putting this particular entry in terms of a continuing involvement, that is a partial derecognition as a continuing involvement approach, this is only to the extent of, you can say, as we took the fair value of the financial guarantee and the amount of guarantee. So effectively, what you land up recording in this case is only the amount of guarantee, 5 crores, and the fair value, 0.5 crores. The amount of liability recorded in this case is very less as compared to the amount of liability recorded in this case. Standard setters were very clear that either we tell you to remove the entire asset, or we don't allow you to touch the asset, or we will allow you to, remove the asset and then recognize a nominal asset and a nominal liability in this case. And I think just to remind you that this full derecognition applies in which cases? Either you meet the step 1, expired, or you meet the step 1 and 2, risk and reward is transferred. So if I were to just add the elements, when do you apply this full derecognition accounting? Either you say the cash flows have expired, you apply this accounting, or you say that the cash flows are transferred and the risk and reward is also substantially transferred. Then you do this kind of accounting. And if you say in this particular case that there is no derecognition, then you say the cash flows test fails. The cash flow test fails in this case, or the cash flows are transferred, and we can say the risk and reward in this particular case is substantially retained. Then you apply this particular test. Then in this particular case, no derecognition takes place, and partial derecognition takes place only when the cash flows are transferred. The risk and reward in this particular case is in a situation that it is neither transferred nor retained, and the control test in this particular case is supposed to be transferred. So this is the parameters along with the journal entries, which gives you a mind map. So this was indirectly a mind map in terms of how the accounting and the parameters in terms of derecognition of the assets is applied. Practically, this is a very, very important area of work, because applying this derecognition principles in certain complex accounting situations can be a real challenging task indeed. But I think I've still tried to give you the overall picture that when you should be very clear on 2 inputs, I would say. You need to be clear on the input number 1. What are the parameters when full derecognition applies? What is the kind of accounting treatment which takes place? What is the parameters when no derecognition can result, and what is the accounting entries in those cases? What are the parameters when a continuing involvement approach applies, and what is the accounting treatment? So this is all covered out here. But is the derecognition of financial assets over? No. The financial assets derecognition has now got 2 more elements. One is a PTA, a pass-through arrangement, and one is a case of derecognizing a part or the entire financial asset. But I think before we go further, I didn't take your scores of comforts. I'm not expecting very high scores at the moment, but I think I still want to get your comfort zones on a scale of 10. What is your comfort zone on a scale of 10 on the concept of derecognizing principles and the accounting entries for derecognition of financial assets? Complicated question to ask, but I get a good score of 8.5 by 10. That's wonderful indeed. Once you revise this bit, friends, trust me, you're going to get more hold on that. It is complicated, undoubtedly, but it is very interesting at the same time. Okay, so let me just come back on the agenda. I started off the journey and I am now again going back to the chart with which I started. I've covered all the permutation combinations. But now in this particular case, what I am looking at is the inputs in terms of this question now. Okay, first I think let's see the case of PTA. I gave you that this is the case of PTA. So we need to show you some inputs. No, not on a PTA. Yes, I think let's make some background on a PTA at the moment. This is part, and then there is a PTA. Now this is slightly also complicated indeed. Oh my God, I'm just going to make some inputs. I know we are almost, end of time, but I just want to make some inputs in the next 3-4 minutes. But don't worry, we'll make some good backgrounds on this. But let me just kick off the concept. A makes a 5-year interest-bearing loan. It says A makes a 5-year interest-bearing loan of 100 crores to B. I just want to give you a basic input at this stage just to create an image. Just watch this carefully. Just watch this carefully. There is a company A and it creates a trust. And in this particular case, they find out some unrelated party investors, unrelated investors. Now, watch this chain carefully. I'm just going to give you the concept of what is a PTA. We'll tackle the concept of the conditions later, but just want to give you what is a pass-through arrangement. Now, see what happens. Company A is in need of funds. So what it does, it creates a trust and passes on the right to receive the cash flows from the financial assets to the trust. So A, what it does, it creates a special purpose vehicle in the form of a trust, SPV. So what it does, it pools, you've done the concept of what is called debt securitization in financial management. So this is PTA is nothing but it's a debt securitization concept. So in this particular case, what A would do, that he would create a trust in this particular case, and the trust will issue securities to unrelated investors. The trust will approach unrelated investors and tell them that, would you like to buy securities from me? Now, these unrelated investors will say, why should we buy securities from you? Who are you? We don't trust you. So in this particular case, the trust will say, so don't worry, at my backend is the company, which is A, which is a big well-known company. So I am just an intermediary between you and the company A. And what I'm going to do today, you are going to buy securities and give me money. I will pass this money to the company A. And then the company A will pool the financial assets, and whatever cash flow comes, I'll give it to you. So what happens that instead of the company A raising the money directly, it creates a special purpose vehicle, a trust in between. So what it does, the money is raised from the unrelated investors, comes to the trust and given to A. And A passes on the cash flows of the financial assets through the trust to those unrelated investors. So getting heavy. So no worry, I just wanted to tell you about a PTA. What we'll do in the next session, we are going to do a discussions on a pass-through arrangement and also give you insights on when do we derecognize a part or entire of the asset. Then we got the inputs in terms of derecognition of financial liabilities. And then we'll come to the next area of discussion, that is hedge accounting. Wow. So I think, friends, that's all. 10 out of 10 score, Pooja. That's wonderful indeed. So I think that's all for the day so far. We are going to carry forward this journey of discussions in the next class with you. That's all for the discussion. Please make your revisions. Any questions, go ahead. So must have been quite a heavy day indeed, but I guess once you revise, friends, you're going to get a good hang of things. Okay, I guess no further questions coming in. So I guess, friends, that's all the time for today. So I'm going to see you back again on Saturday with the continuation of this and more agendas of discussion. Thank you very much. I'm going to see you in the next class. Bye-bye and take care.